Hello, everyone, and welcome to Market Pulse, where we're keeping you plugged in to what you need to know to navigate today's economic landscape. I'm your host, Olivia Voltaggio, and I serve as Senior Content Manager for the U.S. Information Solutions business here at Equifax. Before we get started, I'd like to briefly run through some logistics. Please note at the top that the opinions, estimates, and forecasts presented are for general information use only. Small businesses drive the economy, but capital access and lending confidence are shifting. Entrepreneurs increasingly use non-bank, private credit, and alternative financing, reevaluating cash flow amidst economic challenges. New businesses are also rising from individuals seeking extra income. On today's Market Pulse, in recognition of Small Business Month, we'll navigate the K-shaped commercial landscape. We'll compare small and large enterprises, analyze confidence and hiring trends, and discuss financial strategies for growth. This webinar is being recorded. You'll receive an email notification when the recording is available to view. You can access the slides now by clicking on the Resources button on the bottom of your presentation screen and selecting Documents in the Resources window. In that window, you can also access links to other resources such as the Main Street Lending Report and the Market Pulse Index Report. As we go along, please add to the conversation and submit your questions using the Q&A button at the bottom of your screen. We will leave some time at the end to address your questions. We're pleased to welcome back Dr. Robert Westcott, President of Westcott Strategic Advisors and founder of KeyBridge, which has served global financial institutions, Fortune 500 companies, leading nonprofits, and government agencies since 2001. Rob served for 4 years at the White House as Special Assistant to the President for Economic Policy and as Chief Economist at the President's Council of Economic Advisors. I'm also thrilled to welcome our guest speaker for today, Jill Molitor. Jill began her career with Stearns Bank in 2000, starting as a sales representative in the Equipment Finance Division and quickly expanding her expertise across multiple facets, including credit, documentation, fraud, and compliance. Over her tenure, she has held leadership roles such as Chief Credit Officer and has served as Director of Credit and Fraud Administration since January 2025. She oversees the development and implementation of credit and fraud-related efficiencies, internal controls, and actionable reporting to uphold Stearns Bank's credit-strong culture. Jill is highly credentialed, holding the Certified Fraud Examiner, CFE, Certified Lease Finance Professional, CLFP, and Certified Financial Crimes Specialist, CFCS certifications. She is actively involved in the industry, serving on the CLFP's Board of Directors and the Equifax CFN Advisory Board, and volunteers by presenting financial mastery and fraud prevention seminars. Finally, joining us from the Equifax advisory team, we have Jesse Harden, who will present the latest small business and consumer credit insights. We also welcome Equifax advisory leader Emmeline Aliff, who will join Jill later in conversation on the challenges and opportunities facing small businesses and commercial organizations in this environment. And now, let's kick things off with Rob's macroeconomic observations. Rob, over to you.
Thanks, Olivia. Well, a lot's going on in the world economy and in the U.S. economy, and we're going to jump in and try to make a little bit of sense of it. I was last with you 2 months ago, and events in Iran were just unfolding at that time, and we kind of speculated. I think at that time, gasoline prices were up like 15 or 20 cents, so we kind of speculated about where things might go. And I'd say now we have a better sense of what's happening. I think we realize that these higher prices are going to be more persistent. They're going to last longer. And so I think that's one thing it's becoming clearer. Now, and clearly they're going to be a negative for the world economy and for the U.S. economy. But things are constantly changing. And on about March 28th, something remarkable happened. And that was the stock market decided it was going to go bonkers. And it's up sharply. I think the S&P 500 index was at like 6,500 at that date. Now it's like 7,500. And so it's really taken off like a rocket. And so now we have a real battle royal taking place in the economy. We have depressing effects of higher oil prices and gasoline prices, but we have the positive effects of all the enthusiasm for AI and NVIDIA again and the stock market. So we have a couple of these real battles going on. So a couple of tailwinds just to highlight for you, and I think you all know this, but AI investment is booming, strong stock market. We're going to talk for a second about the individual income tax refunds that are running hotter than last year. And also we have tariff refunds from the 1977 tariffs that the Supreme Court said were not legal. That money is starting to flow back to businesses. So those are some tailwinds. But we have some headwinds as well. We have weak consumer sentiment, which is still a concern to me. We have low small business confidence. We're going to get into that, and that's going to be a focus for this discussion for the next hour. We still have a very soft labor market, and we have those higher oil prices. So those are the things we're going to be talking about today. So if we could have the next slide, please, Jayla. So first thing I just want to say, from a public policy point of view, there's really been 2 steps forward and 2 steps back since I was last with you 2 weeks ago, or 2 months ago. So I mentioned those personal tax refunds. Yes, the average person a year ago got about $3,000 in tax refunds. This year they're getting about $3,300. So that's about 10% more, 11% more individual refunds. We estimate in aggregate we're up about $50 billion over last year. So that should be a plus for the economy. And if any of you run retail stores, used car dealerships, new car dealerships, stores that sell phones, you know that tax refunds really drive sales. This is when people have $3,000, they walk in, plunk their money down and buy a new iPhone. They make a deposit on a new car. And so these really are these have big effects. So the other thing is we've got about $166 billion of the tariffs that were collected last year starting to be refunded. The government is not releasing these numbers on a weekly basis, but we estimate about 1/5 of those funds have now flowed out. So this is filling up some small businesses and is making some businesses feel a little fuller and a little bit happier because they've got the refund money back. However, there are 2 steps back that are going on. One is the administration has announced that they're going to have new tariffs being rolled out in July that are going to, in some ways, take the place of the tariffs that the Supreme Court said were not legal. We don't know what the nature of those tariffs is going to be. We don't know what the numbers are going to be. But we think that's another headwind that's going to be hitting the business sector. And I wouldn't be surprised if they basically replace in dollar values the tariffs that have been that the Supreme Court said were not legal. The other thing that we have to deal with, and we're going to talk about, is oil prices, and they're another negative. Let's go on and talk first about the good news. Next slide, please. And it is AI, and it's those hyperscalers that are going to spend $700 billion in data centers. And you all know this, and it's driving the economy, it's driving the stock market. In the past year, AI-driven investments for data centers have explained about half of U.S. GDP growth. In fact, in the first quarter, they explained about 2/3 of all U.S. GDP growth in the first quarter of this year. Now, that included a bunch of imports of chips from Taiwan and South Korea and so on. And so probably the net effect is more like half or just a little bit under half. But still, AI is really driving the U.S. economy right now. We're very dependent on it. This is a survey that was done of chief financial officers recently, and you can see last year the CFOs thought that AI was adding maybe up to 0.5% to companies' revenues. This year, they're expecting AI can be adding maybe up to 1.5 percentage points to their company's revenue. So it has many benefits. The key question is, can this big boom of AI investment, can it be sustained? And so that's a question that is still out there. And so far, everyone is optimistic, but we'll see whether it can continue. Next slide, please. I just want to talk about the labor market for a second. We've been seeing pluses and minuses on the job count, and you know that. We went 11 straight months with jobs up 1 month, down the next, up the next, down the next. Okay, we've had 2+ months now. That's good. But one question is, how can we keep bouncing around zero? And I just wanted to share a little the numbers on the right. Because we have basically shut the door on immigration, we have much fewer, we have a much smaller need to create jobs to keep the unemployment rate fixed and to absorb the people coming into the labor force. I just want to share this data on the right. This is the number of jobs that the U.S. economy needs to create per month to kind of keep absorb the new entrants. You can see when the baby boom was coming into the labor force 30, 40 years ago, we needed to create 200,000 jobs a month. Those are the whole arrows across to the right, that's basically different generations, Generation X, millennials, and all that. But you can see the huge surge over at the end. When COVID hit, we imposed Title 42. We said the borders closed because of health concerns. And then in 2022, we opened the border, and you can see we had a surge coming in. And so that greatly disrupted the labor market. Now we only need about 35,000 jobs a month. When that number is so low, a little bit up, a little bit down makes you go from a positive number to a negative number. And we think this pattern is going to continue. So I just want to make that point. The next slide I just want to show is another concern we have as economists, and that's real disposable income. This is income after you adjust for inflation, after you adjust for taxes. And these numbers have been steadily going down over the last couple of years, and they're getting quite weak. And this is one of the main concern that economists have. Consumers have kept spending. They kept spending late in 2025, and they kept spending even in early 2026. But a lot of the way they were able to spend was because they were dipping into saving. Saving rates is very low. But the other thing was upper income households were tapping into huge equity gains, and that was helping to sustain the economy. But the underlying health of real disposable income has been a concern, and it's not in great shape. So the next slide, I just wanted to talk for a minute. We've talked in the past about the K-curve, and Olivia, you mentioned it at the start. There is little evidence on the left. This is data from 2018 to the end of 2022. There was little evidence of a K-curve before 2023. What is a K-curve? We've talked about this. K-curve is just, if you're at the top of the K-curve, it means you own your own home and you have a stock portfolio, and so you're doing well. If you're the bottom end of the K-curve, it means you don't own your own home, you're a renter, and you probably do not have an equity position, and those households are doing have substantial more challenges. We did not see much of a K-curve until 2023. We think the data, this is New York Fed data, we think it shows a pretty clear evidence of a K-curve the last 3 years. The data on the right shows that upper income households were definitely increasing their spending much more than lower income households. And I think the biggest reason for that was stock market wealth. The upper income households had the stock market wealth, and they were able to keep spending at higher rates. Now you see all income groups have been hit the last month. This is March data right there. So you can see gasoline prices going up has started to take its toll on all income groups, especially lower income groups. Okay, let's go on. I wanted to talk about a couple of risks to ponder. Next slide is one that I showed you 2 months ago. We've updated it. And it is clearly oil prices. Oil prices up, gasoline prices up, and we've got here 3 other oil price cycles in the last quarter century. What happened? The last one was the Ukraine-Russian war that started. Each of these cases, oil prices started about $60 a barrel. It went up to $110, $120 a barrel. You can see what happened to gasoline prices. We're interested in what happened to inflation. And in all of these cases, it drove inflation up 1.5 to 2.1 percentage points. We're up 1.4 now, and we expect that's going to keep going up. And so we think we're going to quickly be at 4% on the CPI inflation, for example. So I just wanted to make that point. I think the markets are nervous about that, and the Fed is nervous about that. More about that in a second. Let's have the next slide, please. A second risk that we're monitoring, and many people are starting to use this word that you haven't heard in like 30 years, and that's stagflation. And so what is stagflation? Well, it's kind of a multi-year period of economic malaise with high inflation and low economic growth. We had the classic stagflation in the 1970s. We have 6 years of it over there on the left. I think this is what my colleague Lauren thinks people look like in the 1970s. I don't remember it quite being like that, but anyway. Average GDP growth in the stagflation era, 0.3% a year, almost no growth. Average unemployment rate in this period, 7.4%, high unemployment. Average CPI inflation in these stagflation years, 9.6%, high inflation. This was a period of really bad economic performance. So one question that many people are asking, saying, oh, could we have stagflation again in 2026? I don't think we're going to see the 1970s type stagflation. U.S. is energy independent, so we have much less We have much more insulation from physical shortages of oil. We have more of a history of the 2% Fed inflation targeting. So that's still in the back of many people's heads. And another big difference from the 1970s is at that time, 25% of the workforce was unionized, and we had many COLA clauses, cost of living adjusted clauses. So if you had 9.6% inflation, the union said 9.6 plus 2%, you get 11.6%. It was very hard to stomp inflation out at that time. And today we have less than 10% of the workforce in unionized. So I think I see some big differences there. I will say, I don't think we have to worry about stagflation. We could see slowing economic growth, so I'll call it more of a stagnation story, but with moderate inflation. And I think we could be seeing 4%, 4.5% inflation without too much trouble. Will have consequences. Equity markets, I just want to point out, went flat sideways for 10 years during the period of stagflation in the late 70s and early 80s. So there would be some consequences, I think, if we were to have a slowdown. So the third thing I wanted to mention, next slide, is the Fed. And I wanted to just talk about Mr. Kevin Warsh is coming in. He's being sworn in tomorrow as the new Fed chair. And so we are now entering a new period at the Fed. We're not quite sure how it's going to shake out. The president wants lower interest rates, and I think we all know that. Mr. Warsh, his history, this is a little analysis by the Financial Times of whether he made dovish comments or hawkish comments. He does have a history of being more dovish when there are Republican presidents than Democratic presidents, you can see. So I do think that's, he's inclined to want to have lower interest rates. But we have this, we're knocking on the door of 4% inflation, and the other members of the Federal Open Market Committee are nervous about inflation. And so I think he's a smart politician. I think he knows he can't be pushing for lower rates if that's out of sync with the other members of the FOMC. So I think we're going to be looking pretty carefully at his first few votes and how those votes come. Can he build consensus? But I think the one thing I want everyone to know is he is not a Keynesian. He is a monetarist. He believes that Milton Friedman had the right view of money, that it was the money supply that determined economic activity. He thinks the Fed's balance sheet has gotten too big at $6.7 trillion. He would like to shrink the Fed's balance sheet. And so that's a tension that's out there. He may want lower rates, but he also would like to shrink the Fed's balance sheet. Stay tuned on this one. Let's go on. Just quickly, I want to end with a couple thoughts on small business, and then we'll have some discussion of that. Just want to set the scene here. The National Association of Independent Businesses, NFIB, has been doing a survey of small business optimism for 50 years. And I just wanted to share this data with you. This group, they're small businesses. They generally like low taxes. They like light regulation. They generally lean Republican. And you can see their data over the last 15 years here. But generally, they like they are more optimistic under Republican administrations than Democratic administrations. However, we are seeing some pretty good falls in their optimism in the last year. I think it's concerned about tariffs, it's concerned about rising oil prices, and I think they are taking their toll. We have other data. The Bank of America has a profit measure of small businesses. They reported a pretty sharp decline of small business profits in April. Again, because a lot of small businesses have to pay diesel bills for their trucks and higher delivery costs because of higher energy prices. I think that's starting to take its toll on small business. And then my last slide, the next slide, is just one more little piece of insight into the way small businesses are thinking. We economists don't like uncertainty. We don't like things like tariff rates that go up and down and shift. We don't like oil prices that go up and down and shift and so on. And we think those are taking their toll on small businesses. This is one of the lowest numbers that the NFIB has ever reported for capital spending plans for small businesses. They're pretty pessimistic on spending right now. They're not benefiting from all the AI boom. They're not benefiting from all the build out of data centers. And so their capital spending plans are quite depressed. Lastly, on the right, I think this is always kind of interesting. They ask small businesses, what are you worried about most? And one of the top concerns is still the quality of labor. I want skilled workers who I can hire and would trust. But another thing that's bubbling up sharply is inflation. So these are some of the concerns. Olivia, I'll turn it back to you and we'll get further into the discussion of small businesses. Thank you.
Thank you, Rob, for sharing these insights and giving us that macroeconomic backdrop. And now we invite you to respond to a poll. Which point of pressure is currently your organization's highest priority for defensive risk mitigation? I'll give you a few seconds to respond, and then we will shift onto consumer as well as small business credit trends. All right, if you have not already done so, make sure you respond. I'm going to close out the poll. And here are our results. Thank you for participating in this poll. And now I will turn things over to Jesse Harden to present the latest small business and consumer credit insights.
Yeah, thanks, Olivia. That was a really balanced result there. So it's great to be with you again today. We're focusing on consumer credit trends and then also the breakout that we have for health of small business. Before I dive into the data and talk a lot about Rob's really cool picture of the close in the 70s, I did want to keep two housekeeping items in order here. So first, the key dates for the data we're looking at. Originations data is from January of 2026, and it's going to predate the Iran conflict. So just kind of keep that in mind. Also, on the portfolio side, the portfolio data is as of March of 2026, and that's going to include outstanding balances, utilization, limit amounts, et cetera. We also have some green and red directional arrows. Those are going to help indicate impact to the consumer. They're not necessarily built as an indication of benefit or disadvantage to any particular industry. And then on the next slide, probably most important is housekeeping item number two. We're very excited to launch the Q2 Market Pulse Index, which is going to be out in June. You'll recall from my colleagues, the Market Pulse Index is a dimensional view looking at the financial state of the U.S. consumer that we built at Equifax. And we incorporate credit data, debt data, income, asset information, and it's really designed so that you can get a better understanding of the population as a whole with an indexed average, but then you can also track velocity changes within different populations, building upon that K that you just heard Rob talking about. Also, you can look at impacts to generations, specific credit and income tiers, or regional differences. We've focused a lot on the outcome of the K shape, so looking at the pivoting middle, thrivers, and the strivers, which you'll hear me talking a little bit about today. So be on the lookout for that. That's going to be in Q2, early Q2. So next slide. Before we dive into credit trends, I just want to keep three realities in mind regarding household credit health. So first, I would say that savings are falling as living costs continue to consume the nominal wage gains that we've seen. You heard Rob talk about it, and we'll see some of that in our data as well. Also, consumer spending is credit driven. So we're seeing that the pivoting middle and those striver populations are increasingly relying on credit cards and alternative debt rather than cash. So that's an interesting trend that we're seeing. And then sticky inflation, it really acts as a regressive tax. It's driving a wedge through the middle of that K shape of the economy. So then on this page, looking at originations, we can see a couple things. Sector-wide expansion is still present. We see mortgages are up 37%. Bank cards are up 12%, personal loans at 10%, and then auto loans and leases up 3%. And I think the healthy growth really reflects the favorable rates that we've seen, certainly in last year and to some extent earlier in this year. We have seen an uptick in treasury yields that's going to drive some decisioning, I think, in Q2. It's certainly been driven a lot by higher inflation and the Iran conflict. So we're going to watch that closely to see how that impacts future originations, especially as consumers continue relying on credit to fund spending. With that, let's turn to the next page and we're going to look at aggregate loan balances. So looking at overall consumer debt in the US, we've seen balances stand at about $18.2 trillion. Total debt grew about 2.8% year over year, and it's remained roughly flat month over month. That's consistent really with what we see in the broader US in terms of economic growth. If we break down categories, mortgage debt really anchors the overall growth. It was up about 3.2% annually to $13.5 trillion. Revolving debt's shown a short-term divergence. We've seen annually 3% increase, but month over month about a 1.4% decrease. And I think the drop really signals and really shows that there is an emerging consumer caution. So larger tax refunds helped some in those segments pay down balances, but higher gas prices are preventing some of those in the middle income households from doing the same. And then on the non-revolving debt side, we've seen some stabilization. We've seen a modest growth, about 1.3% year over year. On the next slide, then we can break out and look at different debt categories, seeing what stands out. And so digging deeper into balance growth on this page, we can see that there's sort of a distinct consumer behavior emerging. So auto loans remain steady. That's in the face of the cooling vehicle prices that we've seen. Personal loan balances are surging. They're up nearly 11% year over year. I think that has a lot to do with the striver population in terms of the strivers increasingly turning to those personal loans for an ability to navigate higher prices and gas disruptions. On the bank card side, bank card balances dropped 1.4% month over month, and that's despite annual overall growth. So I think overall we're seeing healthy credit use at the top of the economic spectrum. Conversely, though, if we think about strivers, those strivers, again, that's kind of the bottom end of the K. They're actively shedding high interest retail debt and consolidating through personal loans. And that's a trend we're going to want to continue to watch. On the next slide, turning to utilization and limits on revolving products, we can see that general bank card limits increased 6% to $5 trillion overall. Utilization is down though, almost 2%, sitting at about 20%. So consumers have available credit as a safety net, but we're seeing that they're not choosing to tap that for everyday spending yet, at least. And that's a positive trend that we're going to want to continue to watch. In contrast, when we look at home equity line of credit, we've seen credit limits are up 6%, but utilization's jumped almost 7% to 43% overall. And so I think homeowners, especially those thrivers that we've seen and Rob talked about at the top end of the K, those thrivers are strategically leveraging their property equity instead of swiping for everyday credit cards. Okay, next slide, we'll take a look at delinquencies. So delinquencies currently, I think, tell a two-sided story. We're highlighting a stark contrast then between short-term obligations and long-term debt. But the good news overall is that delinquency rates continue to fall, and they remain below great financial crisis levels in all loan categories. So that's, I think, a good sign. Short-term debt, so think of auto, bank card, private label, personal loans. All of those delinquencies are down monthly and annually. So again, a good story there. A little bit different story with long-term debt. So when we look at severe mortgage delinquencies, which is 90 days past due, those are up about 31% year over year. It sounds like a scary number, but I think it's still some normalization from historically low rates. There's also some nuance to where that debt's happening and where that delinquency is happening. So overall, I think consumers are successfully managing daily credit flows. But I do think it's something that we'll continue to watch very closely, especially as we think of what has happened with gas prices and the impact that that could have. Okay, I'm going to switch gears then and talk a little bit about small business credit trends now. And so for context, I kind of want you to think about these three themes as we go through these slides. So first is the idea that there's margin pressure. So we've seen near high default rates and rising input costs across really all sectors, and that's squeezing cash flow and profit margins for businesses. We've seen a pause on Main Street. So despite headlines that we've seen about massive tech and AI buildouts, everyday businesses, I think, are kind of reacting a little differently. They're delaying capital investments, they're pausing hiring, and they're exercising a little bit more caution. I will say, though, that we see a calming headwind, and I think we're seeing that despite the current pain that we have now, some of the data that we're looking at suggests that we could be in a temporary plateau rather than a permanent downward trend. So we'll take a look at this slide here, which is the Philadelphia Fed's Manufacturing Business Outlook Survey. And it's a good, crucial early indicator for broader national economic trends. The data comes out roughly at the first part of the month. When we look at April's data, it reveals sort of a mixed reality, I think, for this region specifically, but probably largely for the nation as well, which is we're seeing surging current activity, but we're also seeing that paired with tightening labor and rising prices. And so when we break down the charts on the right-hand side, we're looking at orders. And so what you can see is the red line shows current new orders jumping significantly. And I think that signals that there's robust immediate demand in the market. However, the dark line indicates that the 6-month look forward, so again, we're kind of looking forward now in an outlook, it's still positive, but it's cooling to some extent from previous peaks. And then on the left-hand side, we're looking at employment, the left-hand chart. We can see sort of a divergence here. We're seeing the red line as headcounts, and the dark line is 6-month forward headcounts. And you can see that on the red line, we've seen a slight dip to near zero, and that I think reflects the immediate employment decline that we've seen small businesses have. And then on the dark left line, we can see that the firms in this survey specifically are anticipating bringing on more staff, and that's a good sign. You know, it shows that there is some stability that's happening. Okay, I'm going to turn to small business lending. So looking at the small business lending environment, we have the Equifax Small Business Lending Index, and we measure specifically new commercial loan and lease volumes. And I think what it does is serves as a really good vital indicator for Main Street's financial health and borrowing appetite. And so what we're seeing is, again, kind of a theme or a tale of two economies, where we've seen massive capital deployment in AI and enterprise, but then we contrast that with a distinct cooling period on Main Street. And so looking at the index, we landed at 127.7, and that represents about a 5.5% drop month over month, a 4.3% drop year over year. We also look at a 3-month moving average to kind of smooth that look out, and that's actually a little bit steeper decline at 7%. I think what it's telling us is that small businesses, again, they're pulling back on new commercial loans and leases, and they're exercising a little bit more caution based on today's environment. A couple more slides to go through here. So we'll turn to small business delinquency and default trends on the next slide. You can see the blue line as our default index. We're currently at 3.3%. That's at a higher level than we've seen in the past decade, but we have seen some stability. Then turning to delinquencies, we look at short and long-term delinquencies, short-term being the red line. Those delinquencies are relatively stable. The same story holds true in the gray line. We're seeing some steady uptick since 2022, kind of a crawl, I would say, more upwards. I think the signal is that defaults may be leveling off, but small businesses, they're still feeling that squeeze. And so we would expect to see defaults continue to remain a little bit higher in the near term. Last two slides I'm going to cover off on looking at delinquency and lending, and then defaults more at a regional level. So we're taking a look here at regional activity. You can see sort of a trend on the left-hand side looking at small business lending index. We're seeing regional divides. And so there's higher growth that we've seen in Texas and southern states. That's flowing from to business friendly environments, from environments that are maybe higher in regulatory costs. And so we're seeing that kind of expansion more eastward and south. We would contrast that with what's happening, though, or what that really means, and that means that we're seeing elevated risks in those areas driven by two factors. First, I'd say that as you see that rapid population growth, you see a rise in consumer debt, which tends to also squeeze capital from small retail businesses and service businesses. And then secondly, you see some sector vulnerabilities. So we see that there's a high concentration in some of these high growth areas of residential construction, hospitality, et cetera. And those can sometimes be impacted as we see things like frozen housing markets and a shift in consumer spending. And then lastly, what that does then in terms of our forecast, I told you I would give you a little bit of optimism here. I think this slide really gives us the most optimism when we look at small business risk and the outlook for risk in the next 12 months. So the map on the left is the reality of where we are now in March of 2026, and that's that we're in a sea of orange and red, indicating higher defaults nationwide. Still speaks to immediate cash flow issues with small businesses. Looking to the right, though, we see in our 12-month absolute probability default index, we can see sort of a reversal. It's a powerful reversal, actually. And we're seeing that forecasts show that we will transition back to a lower risk environment within the next year, over the coming year. Certainly, we have to marry what we're seeing in the credit data with what we just heard Rob talk about from a macroeconomic standpoint, but we're going to keep a cautious optimism out there. So, Olivia, with that, I'll turn back over to you.
Jesse, thank you for sharing the small business and consumer credit insights. And now, before we bring on Emmeline and Jill, we invite you to respond to our final poll. What is your organization's current capacity for evaluating blended consumer and commercial risk attributes? I'll give you a little bit of time to answer here. All right, if you have not responded yet, make sure you do so. Going to go ahead and close out the poll so we can move on to what is sure to be an excellent conversation. And here are our results. Thank you for participating in our poll. And now I'd like to turn to Emmeline and Jill so that they can discuss the current and future state of small businesses and the implications for commercial organizations.
Thank you so much, Olivia. And I'm happy to welcome Jill Molitor here with us all the way from Minnesota. As we do a lot of our preparations for these discussions, I always love to get the personal stories of people and things like that. And one of our shared experiences is talking about finance and math at the dinner table. So we're gonna
Yes.
bring a dinner table conversation here to all of you. Without further ado, why don't we just jump in the interest of time? Um, let's start off we just heard some macro level discussions from both Rob and then Jesse's interpretation of that with some of the data we see in the small business sector. So what I'd like to understand from you and your perspective and how you've been operating, Jill, is how does the divergence between short-term and long-term loan applications influence lending decisions? But I want to add a second part to that. So, furthermore, when evaluating applications, how is temporary financial stress distinguished from a structural decline?
Yeah, so sure, Emmeline, and thank you for that warm introduction. And like you said, this really is a two-parted question. So to answer the first part of this question, we have a strategic focus where we're underwriting loans that are secured by equipment with shorter terms. And what that does is that does provide our borrowers with quick access to funds because we can turn those applications around very quickly and we can make informed risk-based credit decisions by primarily using third-party credit reports. And those shorter terms are going to help position us against market cycles, interest rate risk, because they're, excuse me, they're not locking into lower yielding long-term loans, inflation, collateral degradation, or deteriorating borrower financial health. Those things can result in an increased probability of default. So, just in general, we don't offer a lot of long-term financing loans unless they carry some sort of a government or a like kind guarantee to help protect ourselves. We do specialize in loans that bridge short-term financing needs. So, if we're thinking about construction financing with a stabilization period, those we do underwrite with a short maturity. Payments are calculated over a longer term amortization. And for those structures, even though the loan term itself is short, what we need to really take into consideration is refinance risk. So, in other words, can that borrower obtain long-term financing when their loan matures, and can that financing be at favorable terms? So we're looking at risks like that rising interest rate environment, tightening credit markets, deterioration in their credit worthiness, and then economic slowdowns. Those are all things that we need to take into consideration with that refinance risk. The second part of the question, how do you identify temporary stress versus structural decline? That is imperative when you're assessing credit risk. That temporary stress, it's a known short-term event. Recovery is naturally going to occur when that event resolves or normalizes. Solvent companies, they might have a little bit of a liquidity, like a short-term liquidity situation, but their assets are exceeding their debt. They might have some delayed receivables. There's some seasonality to them, temporary supply chain challenges, or even sometimes a natural event. And those are going to cause those short-term liquidity events, and that business is going to recover. But overall, their cash flow is adequate to service their debt. Structural decline, those are systemic issues. So shifts in customer habits that the company doesn't correct or recognize and correct timely. So maybe they're not diversifying, maybe they're not correcting product or service obsolescence, or if they have an inverted debt load, so like their liabilities permanently exceed their asset value, those are going to perpetually result in insufficient cash flow to service their obligations. And that's going to affect their recovery time. And a lot of times they need to have significant overhaul, time to correct. Sometimes they run into actual solvency concerns. So maybe they need debt restructuring, and maybe they and ultimately end up filing bankruptcy and the bank takes a write down.
Yeah, thank you for that. I know a lot of the laying out that framework is really helpful, especially as we go into some of the more detailed things that I'm interested in discussing. We saw the two poll questions with some focus on personal cash flow, and then data being brought in from a siloed perspective is really those were the answers were fairly diverse in terms of the distribution, but I did see some leading indicators on data being brought in different ways, both from the personal and business side. So when we think about business owners being both the owner as well as an individual leveraging their own credit, like how do you leverage or think about personal financial indicators to understand that whole owner perspective? And what are some of the impacts of this in your decisioning or scoring in
Yeah,
terms of your overall approach? Yeah.
yeah, absolutely. So, more often than not, there is going to be a correlation between a business owner's credit report and their personal credit and their financial strength and their business credit and financial strength, especially if they have ownership in multiple businesses. So, really diving in, understanding how a business owner or guarantor pays their personal obligations, that can really serve as an early warning indicator of future business default. And additionally, when we're looking at larger ticket loans, if the guarantor financials are collected and reviewed, that holistic global cash flow analysis, that is imperative because weaknesses in an affiliate business or in the guarantor's financial strength, those can really be a precursor that the borrowing entity's future ability to repay its debt obligations might not be as strong as what you're seeing in a silo.
Yeah, so you hit on cash flow a few times now, so I wanna talk through that for a second. Thinking about if we're there's many people out there who are working with commercial risk officers or in that space themselves. What advice would you offer to a commercial risk officer, even from the lending side, to stay agile, especially when you're trying to understand how to maintain cash flow liquidity?
Yeah, so first and foremost, monitor your portfolios and use real-time data. And you want to look at
Mm.
those in both an individual loan and a loan portfolio perspective. That's going to help identify, assess, respond to existing and emerging risks. That can really serve as an early warning indicator. And that's going to help you identify changes in borrower behavior, again, at an individual loan basis, and portfolio behavior and financial strength. And that can help bring forward any payment delays before they even occur. Stress test your portfolios and use multiple and overlapping variables, simulate impacts on the portfolio, and that can help with development of forward-looking decision metrics versus just reliance solely on historical performance. Thinking about cross culture of cross-functional collaboration between teams, so that's going to involve getting your legal team, compliance, credit, lending, and leaning on your data scientists to bring in actionable data. Those, again, though, bringing those in is really going to help understand loans and portfolios of loans so that you can make risk-based decisions. And that's going to really help manage and guide your organization. You're going to focus on how to respond, how to adapt, adjust your business strategies, diversify. You can help develop contingency plans that's going to help to cope with that market volatility.
Yeah, so to take it a little bit further on that, the personal credit for business, we have a stat that's over 50% of owners will use and leverage their personal credit for business. And my expectation is you've seen a lot of that too, given our conversations.
Mhm.
How have you adapted underwriting to evaluate that linkage beyond the business P&L? And is there any additional information you'd be able to comfortably share on that?
Yeah, absolutely. So the concept of evaluating that whole owner, that's not new to Stearns. That's always been our focus and our policy because as you mentioned, it is not uncommon for owners, and especially if they're a small business owner, to use personal credit for business in some capacity. We see that very, very frequently. And so evaluating how that business owner or the owners pay their personal and affiliate debt obligations, again, that's going to be a reflection of how we would expect they're going to pay their business debt obligations. There's typically a correlation between the two. And also, in order to really understand their holistically owned debt obligations, reviewing that personal credit profile is imperative so that you can identify if there's any debt obligations on the personal credit report that are actually used for the business. And for loan applications where you do a financial analysis, you need to reflect those business debt obligations from business cash flow versus from their personal cash flow, or also making sure that you're only hitting them either on the business or the personal side for that debt payment. You don't want to double hit them for that.
Yeah, thank you. That's I really like the way you described that from an approach standpoint. Very methodical, to be able to pull in the information across the various places like you have. So I'm going to pivot a little bit because you've talked about lending, you've talked about assessing data from business, consumers. I know you also have some deep expertise in the fraud space, and so with respect to emerging fraud and digital trends, what are some of the trends that you have been observing in fraud, particularly even thinking about advancements of AI impacting small business loans or even on the detection methods?
Yeah, so I always say, and one of my mentors told me this, and I repeat it often, that you can outsource or automate a task, but not the accountability of its output. So we
Mm,
can use tools to improve processes. We can use those to bring forward anomalies. We can use
mm,
tools to map data points and using that mapping logic to pull forward situations where a borrower or guarantor was examples previously denied credit. There's indications of debt stacking. They have a thin file. They have prior public records, prior defaults. We can pull those data points forward so that we can take a closer review during the underwriting process. But then we need to have that person, that human touch to ask us the common sense questions. And that's how we can help use data to and trending and automation of tasks to pull forward, is this fraudulent? And it can be fraudulent from an identity perspective or from a false statement perspective. So asking ourselves, does it make sense that they have 20 years in business and they claim to have $1 million in sales, but there are no business trade lines? Using that data to and those tools to review bank statements, tax returns, personal identification for indications of manipulation or even complete fabrication. That's really important in detecting fraud. Multi-step authentication, that is nothing new. That is something that's been around for quite some time, but that is step one. That is a requirement if you're signing into a bank portal to protect both your bank or your other institutions or even your customer. Knowledge-based questions before anybody can access or signing documents, requiring inspections with a vetted virtual inspection company to make sure a company or equipment exists. Those are all tools that we can use that can help detect fraud. And again, what we can't use those tools for is applying common sense. So always ask yourself, does this make sense? Going back, we've had conversations even on Market Pulse here about Secretary of State fraud. Just because it's active doesn't mean there isn't fraud. Understand those changes in ownership, understand the business name, changes in resurrections of that company, failed knowledge-based questions attempts. Those could indicate identity theft. A small shop applying for a large server, does that make sense? That could be an indication of fraud. So cross-reference information received from that data output for inconsistencies.
Yeah, thank you. I think we've got about time for one more. I mean, clearly you've established an authoritative position on how to operate in this time from credit to fraud to just lending in general and how to really combine from a best practices, at least from what I've observed, the business and personal based credit. So the last question I'm going to ask you is, it's a big question, is, yeah, we've been hearing and discussing the various uncertainties, K-shaped economy, all the things associated with that. The thing I'd like to offer to our audience is, how do you recommend approaching strategic decisions in light of those various uncertain factors that the industry may be feeling at this point?
Yeah, so we're an employee-owned bank. Each team member leads with an ownership mentality because we are owners. And that mentality drives forward our innovation. We do business unusual. We're always asking ourselves, what is the impact to risk? We ask ourselves the question out loud. We challenge ourselves. We challenge each other. And we are very open with that question. What is the impact to risk? What if that happens? What if that does not happen? And we use that to drive our growth, innovation, decisions. And it's really led to what we've coined Stern's Gold ownership mindset, because our framework for delivering consistent, human-centric banking powered by owner model, it values character, experience, capability, and that all helps drive risk management top of mind.
I love that. What does it mean for risk? That's a great line to leave us with. I appreciate you sharing the ownership and accountability models, especially not losing sight of common sense. So with that, I will turn it back over to Olivia because we've had a number of questions come in from our live audience. Thank
Thank
you.
you, Emily and Jill. And yes, to Em's point, we will address some questions from our audience. As a reminder, today's webinar is being recorded, and you can access the slide deck by clicking on the resources button on the bottom of your presentation screen and selecting documents. Rob, this first question is for you and came in from Grigoris. Rob talked about a K economy for the consumer. Given the NFIB survey for small business CapEx and top of mind issues, isn't there a K economy for businesses as well?
So that's a really smart question, and a lot of economists are asking that exact same question, even in the last couple of months. So yes, there is a bit of a K-curve effect even for small businesses. And let me just start by saying there's a K-curve between smaller businesses and larger businesses. We've done a lot of analysis on that. I think others on this call have as well. But in a normal economic downturn like a recession, small businesses basically have twice the impact of large businesses. Big businesses the household brands, they have deep pockets, they have capital bases and all that. They don't lay people off, but smaller businesses do. So first of all, we have that. Secondly, if there is an economic downturn, and that's when most of the stresses would build up in the small business sector, it really depends on what are you selling and what is your business line, and is there what economists call inelastic demand for what you sell. You want to sell something that there's inelastic demand for in an economic downturn. So things like food, things you buy in the drugstore. You think of like wireless telephone. People need their cell phones. They're not going to cancel their cell phone in an economic downturn. Those kinds of businesses would do well. But there are other types of businesses in economic downturn, small businesses that may be more optional. Yoga studios, going down the list, jewelry stores, things like that are probably more, they would tend to have much more amplitude and would suffer more in an economic downturn. Good question.
And then, Jesse, we got this question from Naven. What is your outlook on which industries are likely to see growth or slow down, especially looking at default levels?
Yeah, another great question there. I probably would refer back to the Equifax absolute probability default model. And when we look at that data, which is going to forecast out to 2027, we can see that defaults overall are ticking upwards about 3.5%. That's 26 to 27. We do see in sectors like accommodation and food, also transportation and healthcare, we'll see they're going to fare a lot better. And conversely, education, mining, information, those sectors are expected to see a little bit worsening picture. So I think in general, probably still a competitive, pretty tough environment. But I think those sectors roughly on the upside and the downside would be ones where we would think we would see a little better and less improving pictures.
And then
Thanks.
Jesse,
That's a good question.
yeah. And then Jesse, we also got this question from John. Are there any variables that can help predict FICO migration even directionally?
Ooh, put me on the spot. Let's see. So, yeah, I think maybe first I'd say credit utilization spikes. So, thinking of revolving balances suddenly jumping, that's going to have an impact on scores. Certainly, may see a score drop there. Thinking about payment velocity. So, the idea that you see a shift in payment from full statement balances, maybe paying, full statement balances to then maybe making a minimum payment that could signal stress and cash flow. The other one I think that comes to mind is maybe a sudden credit-seeking behavior. So thinking about a cluster of hard inquiries at, all at once in a short window, that can indicate really a need for more liquidity, and be an initial sign that you might see movement in score. So yeah, probably those three I'd go with.
Thank you, Jesse. I think that's all the time we've got for questions for today. So thank you, Rob, Jesse, Emmeline, and Jill for sharing your insights with all of us today. And thank you to all of you for the questions you submitted to enrich today's conversation. And if we could get the slides back up. Our goal, as always, we present a lot of data and insights into just 1 hour, but our goal, as always, is to leave you with some actionable insights. And so, Jesse, as a member of the Equifax advisory team, what actionable insights do you have and recommendations do you have to share with this team, audience today?
Sure, yeah. Thanks, Libby. I would say probably you've heard it from us a lot. So if I sound like a broken record, I'm sorry. But again, thinking of shifting from lagging to leading indicators for risk assessment, really looking forward into what you're seeing and not just the lagging data, but really kind of how you interpret leading data. Again, thinking of alternative data, certainly looking at alternative data to get a better picture of your population. And then I would say lastly, prioritizing precision segmentation. So again, not just looking at averages, but really taking a deeper look at your population, looking at better segmentation. Certainly, we talked about the K. When you think of the thrivers and the strivers and the middle, I think there's a good place to start when we think of how we segment. So Certainly, if you have questions, reach out to us. But I would say that's the insight I would leave you with.
Thanks, Jesse. We hope you'll mark your calendars and register for our next webinar on June 25th, where we will explore wealth trends and actionable strategies for lenders to enhance their credit assessments. You can register for upcoming webinars and also find our Market Pulse Index Report and Main Street Lending Report at equifax.com/marketpulse. All the Equifax data and insights that are presented on our Market Pulse webinars are pulled directly from these reports. To stay on top of all our insights and updates, make sure to follow our Equifax for Business LinkedIn page, which you can link to with the QR code. And don't miss our Market Pulse podcasts, where we keep the conversation going and go further in depth on topics we've discussed here. You can access them on your favorite podcast platform or by listening on the web, which you can link to with the QR code. We always welcome your feedback and ideas for future topics. As we develop our upcoming webinars, rest assured we will continue to listen to all your comments to ensure each webinar stays focused on your most pressing questions. On behalf of Equifax and all of our presenters, thanks again for joining us, and we'll see you next month.